Every year, the story seems the same. Black Friday arrives and a festive frenzy consumes the retail world, culminating in the Christmas sales peak. For most observers, this is the make-or-break season that defines a retailer's success. But this narrative, compelling as it is, misses the most crucial part of the story for savvy investors. The real drama doesn't unfold under the twinkling lights of December. It happens in the stark, quiet aftermath of January. The conventional wisdom is that Christmas sales are the ultimate barometer of a retailer's health. However, this focus on top-line revenue is dangerously simplistic. Retailers build up mountains of inventory for the rush, but what happens to the products that don't sell is a far more telling indicator of a company's true financial discipline. This is the retail industry's most misunderstood period. The weeks following Christmas are more pivotal for stock performance than the holiday shopping spree itself. It is a time when retailers must confront the consequences of their holiday strategies, from liquidating excess inventory to processing a tidal wave of returned merchandise. These January dynamics directly impact earnings, profit margins, and working capital, creating a period of intense volatility and opportunity. While the market digests December's headlines, smart investors are analyzing the data that reveals the true cost of those holiday sales. By understanding the margin-crushing impact of deep discounts and the logistical nightmare of customer returns, you can gain a significant edge. This is when temporary pessimism can create incredible buying opportunities, and where structural weaknesses, once hidden by holiday cheer, are laid bare for all to see. The holiday shopping bonanza sets off a chain reaction that extends far into the new year. It begins with a massive inventory buildup, a high-stakes gamble where retailers place huge orders months in advance. If demand falters, that mountain of inventory quickly becomes a liability. Come late December, the race to clear out unsold goods triggers aggressive markdowns. This clearance is a double-edged sword. On one hand, it boosts January sales figures as consumers, armed with gift cards, flock to bargains. On the other hand, these deep discounts wreak havoc on profit margins, impacting earnings reported in the following quarter. Adding another layer of complexity is the tsunami of product returns. This creates a massive reverse logistics challenge, where each returned item represents a reduction in net sales and a significant operational cost. The process of receiving, inspecting, and restocking ties up capital and further erodes profitability. These combined forces, inventory clearance, margin compression, and the surge in returns, are the core mechanics that make the post-holiday period so critical. For an investor, tracking these dynamics provides a far more predictive view of a company's financial resilience than simply looking at gross holiday sales. To capitalize on the post-holiday retail cycle, investors need to move beyond headlines and dig into the data. The key is to monitor a specific set of leading indicators that provide early warnings of distress or resilience. We'll rely on a core set of publicly available and industry-specific data sources, including cutting-edge analytics tracking consumer behavior in near real time. The first and most critical signal, the inventory-to-sales ratio. Track it via U.S. Census Bureau monthly releases and in companies' quarterly financial reports. A rising ratio is a major red flag, more inventory than sales. Excess stock leads to markdowns, which compress profit margins. Conversely, a stable or falling ratio preserves pricing power and profitability. Next, the volume and value of holiday returns. We'll look at National Retail Federation data and commentary from companies themselves. Spikes in return rates directly reduce net sales and can signal issues with product quality, fit, or customer dissatisfaction. High return volumes also inflate logistics costs, dragging on earnings. We'll use this data to adjust near-term EPS expectations and identify retailers with superior reverse logistics. Finally, promotional depth and real-time consumer traffic. Using price and foot traffic analytics, we can ask, are discounts getting deeper and starting earlier? Are shoppers visiting but not converting? These are signs of weakening demand, forcing margin sacrifice for revenue. We'll piece these data points into a predictive mosaic of retailer health long before earnings. Table of contents, evidence, and mechanics. 1. Post-holiday sales mirage, a tale of two growth rates. 1. The great unwrapping, when returns become a liability. 1. The Black Friday creep, how early discounts reshape the calendar. 1. The inventory gamble, a mountain of risk. 1. The cautious consumer, how retailers adapt or falter. Subscribe and follow us for more videos on shopping smart always.